Whatever success I've had has been more due to my knowing how to deal with what I don't know than anything I know. Betting on the future is betting on probabilities, and nothing is certain, not even the probabilities. That's just the way it is. While what I've given you up until this point is what I believe I know about the future based on my reasoning about the past, what I want to pass along, that is probably more important, is how I make decisions in life and in the markets based on what I don't know.
Lately, there has been so much talk about the economy depth, inflation, and the bubble, and for those of us who aren't familiar with economics, the whole conversation can be quite intimidating. However, those of us who understand what the economy is, know that is really not as complicated as you may think it is. Hello, welcome back to our channel, Money Invest. If you're new here, please subscribe to the channel and enable notifications to be notified of every upload. And today we're going to dive into the Big Debt Catastrophe explained by Ray Dalio. So let me start with the debt cycle. You know, in 1945, we began a new world order. In 1944, we created a new monetary system, the Bretton Woods monetary system, and then we created that new world order, and that created bull marketers in stocks and an American world order for the most part. There's a cycle that we're used to in which whenever you have a debt harmonium downturn, the central bank hits the gas and you can create the expansion, and that produces an increase in demand. And that happens in three phases of the cycle. Normally it's interest rates. You lower interest rates and the economy turns up. But when you hit zero interest rates, what happens is, well, how it did in 1932. We had zero interest rates. So let me explain that. Sometimes it can be a little hard to grasp exactly what Dalio is getting at. I'm not sure entirely if you're aware of this or not, but we've had a pandemic over the past year and a bit. This pandemic has produced a number of things, including business troubles, job losses, a struggling economy, and this, in turn, means that we're in need of a lot of money from the government. So the government says, yeah, I guess I'm forced to give you this money, but it's got to come from somewhere. So I'm going to get my friend, the central bank, to give me this. And so Jerome Powell, head of the central bank, says, yeah, I guess I have to give you this money. And he goes and says infinite money prints and starts engine rolling, prints a lot of money. Obviously, it's all done online now. Any lends to the governments, this is called debt monetization. This type of behavior, Dalio says, is typical of what happens in the late stages of the cycle. Let's understand the situation. When there has to be a lot of selling of bonds and bonds don't give any good return. There's a guaranteed negative return in bonds relative to inflation, and there's a pile of people who own bonds. And this isn't just Americans, but these are international investors owning bonds. And they have to buy a lot more bonds because when the government has to sell a lot of debt, that means they have to buy a lot more bonds. There will not be enough demand for those bonds. When that happens, interest rate rises. That's what you're seeing now. And the central bank is put in a dilemma. So here's the situation. Right now, you get 1.7% a year on the 10-year treasury bond, being straightforward. That is bad because inflation on average is around 2 to 3% of a year. So if you own one of these, you actually lose money each year. So we're in a situation now, the government has to sell a lot of bonds to fund itself. But they're selling a poor product, so to speak. Because with inflation, you actually lose money on these bonds. And this causes a big dilemma for both the government and the Fed. No one wants to buy their bond and no one buys them. Then the government doesn't have any money to give out as stimulus checks or loan for businesses who need it. And then the economy risks a collapse. Now, how does it affect you? What happens when it all goes wrong, and how can we prevent another financial disaster in this critical time in the world? On a very basic level, the economy is simply transactions. When you pay your rent, that's a transaction. When you go grocery shopping, that's a transaction. When you go out for a fancy dinner, that's a transaction. So the Fed can either allow this risk to occur, or they can print money and buy the bonds themselves. The problem, if they do, the second option is first. You risk the devaluation of the dollar because you're putting more dollars into the system, and because there's more, they become worth less. And secondly, you risk inflation. So the Fed is stuck between a rock and a hard place, and the decision that they make has severe consequences and losses. And the other thing, as if this wasn't bad enough, the current holders of government bonds, a lot of them aren't happy with the returns that they're getting because it's negative once you account for inflation. So these holders of government debt could potentially start selling their bonds, foreign investors and US investors who own most of the debt might just decide, hey, there's much better places to put my money. And so if they start selling the government bonds, plus the government needs to sell more of its own bonds, as Dalio says, they could produce a real dilemma. That's classic. It's a long-term debt cycle type stuff. Does this pique your interest? Add your thoughts in the comment section below, and then make sure to subscribe to our channel so you don't miss out on any of our future uploads. So now let's take an example. Think of the economy as being like an individual and their pulse is dropping. When the pulse is dropping, the doctors come running in with a stimulant and they inject stimulants. Now that the economy is rebounding and inflation pressures are rebounding, there's not the same pressure to administer that stimulation when it happens. When it becomes a problem is first. The rising interest rates start hurting financial asset prices first. Typically they hurt bonds, then they pass through and hurt stocks. Because still interest rates affect stocks. And when that start to affect stocks, that's one thing. Maybe the stock market can correct 10 or 15% and the Federal Reserve can tolerate it. When it goes beyond that and starts to affect the economy, that's what you see the real trade-off have to surface. So over the past year or so, a big talking point when it comes to investors is the rise of the 10-year Treasury bond. It went from about 0.6% to 1.7%, almost tripling. So this has affected bondholders a lot. The next stage, as Dalio talks about, and we haven't seen this yet, is when it starts to affect stock prices. It's because the more these yields go up, the more investors start saying, hang on, maybe it's better that I get out of the pricey stock market and into something more safe like long-term bonds. As Dalio says, maybe we see a 10 or 15% correction in the Federal Reserve and it can tolerate us. But after it's gone through bonds and it's gone through stocks, the next stage is it starts hurting the economy because people think instead of spending this money in the economy, I can just save it at a higher rate. They think I'm just going to borrow as much because rates are higher. So I have to pay more of my debts. And therefore they borrow less and put less money into the economy and the economy gets hurt. And so you've got this thing where bonds get hurt. Then what's next? The market gets hurt, then the economy gets hurt, and that's not a great recipe for success. We can just say that these are the signs of the late stages of the cycle. Let's try to understand the key phases performed by Fed with respect to past events. So there's a couple of phases that we need to get our heads around, and these are 3 phases which are key. Just remember these. First is when the Fed decide to bring interest rates down or close to zero. This happened in 1932, and it happened in the current cycle in 2009. But once interest rates are at zero, you can't lower them anymore. So you got to try something else that leads to the second type of monetary policy, which is where the Feds print money and buy financial assets. This has happened only 2 times throughout history. The interest rates print money and monetization, but that only goes so far. Sometimes you end up at a place where the money injected into the system does not trickle down and does not go all of the places that it needs to go. For example, what happened recently, which was the banks just hold on to their money as excess reserves. Now this is where monetary policy 3 comes in and the Fed start working with the government's fiscal policy and monetary policy align. The Fed buys government debt and the government uses this money to give the people and businesses. As Dalio says, there's a late cycle of an expansion. That's what's driving the markets and the economy now. Is this the last puff before we see the end of the cycle? No one knows, but as Dalio says, we might be witnessing it in the coming months. And that's it for today. Don't forget to give this video a thumbs up and subscribe to the channel, Money Invest. Thank you so much for watching. We'll see you in the next video. Stay tuned.